Hello, guess what? Last section for the class. It's kind of a doozy though. A little bit long and it's on taxes. Lovely stuff. Also something to note that it's slightly outdated. This past year, some new tax laws were put into place and they got rid of deductions and that type of thing. So don't think that this applies to current tax models, but it does give you an idea of how things are figured. Okay, so how do you prepare income taxes? Well, you start with your gross income. That's all the money you've made. And you take off any adjustments. So, like money that you put into tax-deferred payment plan things and all, and retirement and healthcare and all that. That gives you your adjusted gross income. Then you take off deductions and exemptions, and that gives you your taxable income. So you don't get taxed on everything that you make, and you may not have realized that. If you made $20,000, your taxable income might only be like $8,000. So I guess that's a good thing. That's how you sometimes get refunds. Then you take off credits, and that gives you your total tax and take off what you've paid throughout the year. And if it's positive, then that means that you owe something. If it's negative, then you're owed a refund. Example 1 says, Karen earned wages of $38,200, received $750 in interest from a savings account, and contributed $1,200 to a tax-deferred retirement plan. She was entitled to a personal exemption of $3,900 and to deductions totaling $6,100. Find her gross income, adjusted gross income, and taxable income. So her gross income is the $38,200 and the interest she received in the savings account counts as income. So that ends up with $38,950. The adjusted gross income is that $38,950, and we subtract off the money she put in a retirement plan because it's tax deferred, so you don't pay taxes on it. That ends up with $37,750. And then last, taxable income is the $37,750. And we subtract off exemptions and deductions. Leaving her with a taxable income of $27,350. So that's all that Karen is going to get taxed on. Filing status, you can file single, married filing jointly, married filing separately, or head of household. And these are basically what they say they are. Exemptions are a fixed amount per person. Everybody gets an exemption, and deductions vary from person to another. And I think the deduction is what they got rid of, and they made the exemption bigger. But that helped some people and didn't help others. It did not help me. For the very first time in my life, I'm having to pay out for my federal taxes. With deductions, you can do a standard deduction or an itemized. Actually, I think that might have been the other way around. Anyway, a standard deduction is a set amount for each person depending on your filing status. Itemized is when you make charitable donations and stuff like that. A certain amount of that you can take off your taxes. So if you find out that itemizing is better for you, then you would do that. And we'll look at an example of that in a minute. Example 2 says, suppose you have the following deductible expenditures. $2,500 for interest on a home mortgage, $900 for contributions to charity, and $250 for state income taxes. Your filing status entitles you to a standard deduction of $6,100. Should you itemize? So, your total deductible expenditures was $2,500 plus $900 plus $250. That totals to $5,650. But your standard deduction is more than that. So you want to take the standard deduction. Tax rates. A progressive income tax means that people with higher taxable income pay a higher rate, and marginal tax rates are assigned to different income ranges or margins. So this is what it looked like in 2013, okay? The 10% tax rate, if you were single and you made up to $8,925, then you were taxed 10%. 10% of that you owed to the government. If you were a head of household and you made up to $125,450, then you would get taxed in the 25% bracket, and so forth. As a rule, tax credits are more valuable than tax deductions because a tax credit reduces your total bill by the full amount of the credit. A tax deduction just takes off from your taxable income. A credit subtracts from what you owe. Example 3 says, suppose you are in the 28% bracket. How much does a $1,000 tax credit save you? How much does a $1,000 charitable contribution, which is tax deductible, save you? Okay. So first, we need to, let's see, a $1,000 tax credit is deducted from your bill, so it saves you all $1,000. The $1,000 deduction saves you 28% of that $1,000 or $280 because it just comes off your taxable income. So you can see where a credit is better than a deduction. And I think we've skipped an example. We'll go back and look at that. I think I downloaded the wrong PowerPoint here, but I'll add that on at the end, okay? So the next example says Drew is in the 15% marginal tax bracket. Marion is in the 35% tax bracket. They each itemize their deductions. They each donate $5,000 to charity. Compare their true costs for the charitable contribution. So Drew will save 15% of the $5,000, or $750. Marion will save 35% of the $5,000, or $1,750. So what's the deal here? Drew is in a lower tax bracket, so that means he made less money. If you're in a lower tax bracket, you're going to get taxed less, but your contributions are also going to be worth less. That's how the rich take advantage of the situation a bit, because they are taxed more, but their charitable contributions count more. So looking back, Drew, if we subtract off $750, his true donation was $4,250. Okay, the charity that he donated to got $5,000, but he really only spent $4,250 because he gets the $750 back at the end of the year. While Marion gets $1,750 back at the end of the year, so she really only spent $3,250. Social Security and Medicare tax. So, this is called FICA. FICA is 7.65% of income from wages. And that is the same across the board for everybody. That goes into your Social Security and Medicare, which we're supposed to get back when we get old and retire. Supposed to. It applies to wages, so it doesn't apply to anything like interest or dividends or stocks, just wages, including if you're self-employed. So example 5 says in 2013, Jude earned $26,000 in wages and tips from her job waiting tables. Calculate her FICA taxes and her total tax bill, including marginal taxes. What is her overall tax rate on her gross income, including both FICA and income taxes? Assume she is single and takes a standard deduction. So, Jude's FICA tax is 7.65%, or 0.0765 of $26,000. $19.89. How much is she going to pay in income tax? Well, the first thing you have to do is find the taxable income. She made $26,000, and if you look back at that table, back here somewhere, she's single. It's up to $26,000. So that would be here. So she's in the 15% bracket, and she gets I'm going to stop here because this is wrong. We're actually using the 2017 for now, not the 2013. So I'm just going to stop here and start up this problem on the it'll be in the same video for you guys, but I need to change my PowerPoint. So see you in a second. Okay, I'm back. Okay, so this is what we're supposed to be looking at, the 2017. It updated last year, and then they changed everything again. Okay, so we had already found the FICA for Jude, and we were looking at the taxable income, and it said that she is single, and she makes up to $37,950, so that puts her in the 15% bracket. And it gives her a $6,350 deduction and a $4,050 exemption. So, her taxable income $26,000. Take off the exemption and the deduction that I underlined down there at the bottom. And so her taxable income is $15,600. Her income tax is found like this. We said she's in the 15% bracket, right? So that's all fine and dandy, except if you look back at the table, and I'm not going to flip back there because it took forever, the first $9,325 is taxed at 10%. So even though her taxable income is $15,600, all that $15,600 isn't taxed at 15%. The first part, $9,325, is 10%. And then the rest of that, so $15,600 minus $93.25. So everything above $93.25 is taxed at 15%. So that means the taxes that she owes will be $1,874. Her total tax then is the FICA, 1989, plus her income tax, 1874. Totals to $3,863. Okay? Now, it says also figure out her overall tax rate, it says. The overall tax rate is just her total tax divided by her gross income. So that's $3,863 divided by the $26,000. 14.9%. So what this is saying is, yes, she paid 10% here and 15% here and 7.65% there. But overall, she paid 14.9% if you factor that all in together. Now, I'm going to go back. Well, yeah, I'm going to go back to example 3. Because I had added some more of these problems in here to get some more practice. So let's see. Example 3 said, using 2017 rates, calculate the tax owed by each of the following people. Assume they all take the standard deduction and neglect any tax credits. So, Deidre is single with no dependents. Her adjusted gross income is $90,000. So, every time we start with the taxable income. We take the $90,000 and we subtract off, it says she was single. So single up to, it's $90,000, so up to $91,900. That puts her in the 25% tax bracket. And my kitty is going crazy. Hang on, let me yell. I don't know. The door is closed somewhere, so she's meowing. Okay. So, since she's single, she gets this deduction and this exemption. So, we subtract off the $40.50 and $63.50 so that her taxable income is $79,600. Then, we figure her income tax. And this is the long part. So, she has a part that she'll pay 10% on. Then, there's a part that she'll pay 15% on. And then, she was in the 25%, right? There's a part that she'll pay 25% on. So looking back at the table, up to $93.25, she pays 10%. Up to $37,950, she pays 15%. So that's $37,950. Subtracting off that $93.25. And then the rest of it, she pays at the 25%. So we take her taxable income and subtract off $37,950, and that's what's left. So we get $932.50 plus $42.93.75 plus $10,412.50. $15,638.75. And by the way, they always round up. So $15,639 is what she owes in taxes this year. We're going to look at 2 more situations of the same thing. So Robert is a head of household this time, taking care of 2 dependent children. His adjusted gross income is also $90,000. So, we first find the taxable income. Going back to the table, he's head of household with 2 kids. And he makes up to $90,000. So, he's also or between 50,800 and 131,200. So he's also in the 25% bracket. Now, he gets a standard deduction, and he gets 3 exemptions because it's per person. So 1 for him and 1 for each of his kids. So we'll take off the deduction, and we take off 3 of the 40/50s. And that comes to his taxable income is $68,500. So his income tax is, there's a part at 10%, there's a part at 15%, and there's a part at 25%. So let's see what that is. The 10% part is $13,350. The 15% part is between $50,800 and $13,350. So we'll take the $50,800 and subtract off $13,350. And then the 25% is everything above that. So $68,500 minus $50,800. Okay? So we end up with $13,035 plus $56,1750 plus $44,25. You take that, round up, and he's going to pay $11,378. So you can see that Deidre and Robert made the same amount of money, but because Robert has kids, he's paying less. And then one more example. So, Jessica and Frank are married with no dependents. They filed jointly. They each have $90,000 in adjusted gross income. So they each have it. So they've got $180,000 total. So, as usual, find their taxable income first. So the $180,000 minus, rid of this, they are married, it said filing jointly. So we're under this one. They get a standard deduction and an exemption per person. Let's see, did they have kids? Nope. So we'll just multiply that by 2. So take off $12,700 and take off 2 times 40/50. So their taxable income is $159,200. Figure their income tax. Let's see. 159. So it's above the 25%. They're in the 28% bracket. So they're going to have a part that they'll pay 10% on. They'll have a part that they pay 15% on, a part that they pay 25% on, and a part that they pay 28% on. Okay. I'm just going to flip back once, and we won't do it every time. So the first one is up to $18,650, then $79,900, then $153,100. So the first 10% is on $18,650. The 15% is on $75,900 minus $18,650. The 25% is on $153,100 minus $75,900. And then the last is on $159,200 minus $153,100. So hopefully after working 4 problems of this, you're getting the idea. They end up paying $31,461 in taxes. Okay, there was one more example here. One more topic we need to talk about, dividends and capital gains. You can get dividends on stocks and capital gains. There's short-term and long-term gains. Short-term's less than 12 months, long-term's more. And then there's tax-deferred income, and those were things like an IRA, like a retirement account, or a 401k. All those are retirement accounts. You don't pay taxes on the amount of money that you put into a retirement account. If you've got a major medical plan like AFLAC, or if you, I don't know, the school system calls it a cafeteria plan. I don't know why. But if you're paying, extra for health care during the year into a fund that you pull from, that can be tax deferred also. Example 7 says, suppose you are single, have a taxable income of $65,000, and make monthly payments of $500 to a tax-deferred saving plan. How do the tax-deferred contributions affect your monthly take-home pay? So if you're single with $65,000, if you look back at the table, you are in the 25% tax bracket. Each $500 contribution then reduces your tax bill by 25% of that, 25% of $500, or $125. So your paycheck goes down by not $500, but $375. Let me explain what I just did there. So since it's tax deferred, it's taken off the top before it applies to taxes. So you're putting $500, you're getting $500 in this plan that you can pull from, but it's really only taking $375 off your check because you're saving the money that would have gone to taxes. Okay, so we are finally done with this section. Check your calendar. pull that up real quick. I'm pretty sure I did something exciting. Let me make sure that's true before I lie to you. Yes, I did. I got rid of your 4E lab. Okay, too much to have to do when you're at home right now, trying to figure that out on your own. So you still have the homework, the 4E homework, but you don't have a 4E lab. Okay, and so this is the lesson for April 27th, that Monday. So tomorrow, April 28th, your 4D and 4C homework are both due. I think I extended the 4C because I was late with that video. This Wednesday and the next Monday, the 4th, are review days. So this Wednesday is a Unit 4 review day. Look in Moodle. There's a review there with solutions. There's also a review you can use in my math lab to practice. Please, please, please do this. You need these Unit 4 tests to look better than the Unit 3 tests, please. I'll tell you more about that in a second, too. So, and then the Unit 4 test is due on Tuesday, May 5th. And then you'll have 2 days, the entire of next week, to review for your final exam, which is due on the 11th. And, of course, it's not in class anymore. You'll be able to do it on your own. But it is due on the 11th. And I'm going to tell you something. This is something I used to do, and I'm going to do it again since things have changed so much for you guys. This final exam, if you do better on the final exam than one of your tests, I'll plug it in for the lowest test. Okay? So if you make a 90 on the final exam and you made a 40 on one of the tests, guess what? That 40 becomes a 90. Okay? Just one of them, just the lowest, not all four. But I'll do that for you guys. Hopefully that will improve your grade some, because I know that Unit 3 test was pretty crummy. But so you need to be sure and study for the Unit 4 again and study for your final exam. You've got a week and a half to do it. Almost 2 weeks to study for those tests. Again, as usual, please email me if you need anything. We can Zoom, we can email back and forth, whatever works for you. Please let me know if you need anything. There's also, by the way, reviews for the final exam in Moodle. And I think in my math lab, I'm not positive on that. But you can always go back and work on the other reviews to study for the final two. Okay. Let me know if you need anything, and hang in there.